Fees were generally allowable unless there was a prosecuting of a claim against the government. Now there is a lessening of that. For example, under the prior rule, if you were to do an audit appeal, and even if you won, you would not be able to charge the attorney's fees to the federal grant because it would have been prosecuting a claim. It was considered to be prosecuting a claim against the federal government. Here, if there's a positive outcome and there's no audit recovery, then you are allowed to charge the fees to the government. There is a change here, and the change is in the old circular, the prior circular, talked about employee morale, health, and welfare. Under the prior circular, there was no direct restriction or requirement on employee morale expenses, except that you couldn't use federal funds for your federal employees to provide morale activities, whatever they would be, unless you provided them to your non-federal employees out of non-federal funds. The rule has changed here at the behest of the Inspector General that morale is out of this section. So it's employee health and welfare only. The morale part went out. I dare say there probably aren't too many expenditures that would have qualified only as morale anyway, but that is out of the circular completely. Entertainment is no change. Entertainment costs are never allowable. Entertainment obviously rarely comes up, but sometimes it comes up in terms of when there's a conference expenditure, and whether if part of the conference there's some entertainment, hiring a band or musicians or DJ, things like that. That's not allowable. Fines and penalties are never allowable. Travel costs have the underlying rule hasn't changed significantly, but there are a couple of changes. The travel costs can be charged on actual per diem or mileage basis. This is only a change because that language is new, but certainly that was always permissible. But there has to be a written travel reimbursement policy. The agency has to have a written travel policy. If the agency does not, then the travel costs have to be reimbursed according to the last bullet, which is consistent with the federal GSA schedule. So if the agency doesn't have its own travel rates, per diems, or whatever, then it has to go to the federal rules. Now, the third bullet is something that is a requirement that came about not from the circulars themselves, but it came about from monitoring and audit findings. And that is that the grantee has to have documentation that participation of the individual in the conference is necessary for the project. So before, what generally was looked for was proof of what the conference or activity was, which was sort of satisfied by agendas, and proof that the employee actually attended, which was satisfied by sign-in sheets and things like that. But now it's much more specific to say that there has to be documentation, so there has to be written documentation. You'd still have to have the other basic documentation. Actual attendance always has to be documented. Sign-in sheets again, or some other evidence of attendance. The employee brings back an agenda or things like that. But also the documentation that supports the participation is how the participation is relevant to the project that's paying for it. Now, the greatest change in the circular is the time and effort documentation. And the greatest change is that the circular, if you're familiar, if you remember, the time and effort documentation, we had the very specific requirement, and it came from A87, and A122 for nonprofits had a similar requirement, not the same, but similar. A21 for universities, sort of different. But for us, for the school district, for the state, we had A87 time and effort documentation. What was that? That was work on more than one cost objective, you have to have a monthly PAR. What was a PAR? Personal activity report. What did the PAR do? It divided the time, or it indicated the division of time, and supported the allocation of salary. So someone who worked on Title I, Title II, and Title III in equal shares had to have a PAR, a monthly PAR that showed that for that month, 1/3 of that time was on 1, and 1/3 on 2, and 1/3 on 3. The person had to be paid that way. If the person wasn't paid that way because the salary had been adjusted at the beginning of the year, there had to be reconciliations, and we had that whole process. And even someone who worked on a single cost objective, who did one thing, had to do a semi-annual, had to do twice a year. I work 100% of my time on this program. So that was the time and effort documentation before. What did we get here? We got a circular that says that there has to be some sort of documentation, certification that supports the time spent or the salary paid. It does away with all of the PAR requirements and all of those other specific requirements. Now, here's the open question on this. Let's go through this and let's see where it's going to take us. So we've got the basic requirement, and that there has to be some documentation of a personnel expense for every employee who's paid in whole or in part with federal funds. We've still got that provision. Anytime you see the 200 or 300 or 400 dot and another number, that is a specific reference to the OMB Circular. So you'll know if you want to look up the actual text. So that means that we are taking directly from that circular. Or, and this again, the rule is carried over from previously, the general rule, if the salary is going to be used to meet a match requirement or a cost share, it also has to be documented. But what does documented mean now? Well, we've got the cost objective definition, and I mentioned that in the beginning. It's a program, function, or activity, or award, or a subdivision, or a contract, or a work unit for which cost data, now the new language says, are desired. But again, you can't really do this unless you segregate the cost data. So I don't think the desired is the desired word here. It should be required. So we're going to look at the cost objective. The charges for the salaries. Now, this is the language that we have. And this language replaces A87 that specifically said if you work on more than one cost objective, or a federal and a non-federal, and it went through, or direct and an indirect, or federal and an indirect, you had to have the monthly PAR. And the monthly PAR had to be signed by the employee. It had to be after the fact. It had to represent 100% of the effort for that period. Now what the rule says, and this is all that's in the rule, charges for salaries must be based on records that accurately reflect the work performed. Doesn't say anything further than that. They must be supported by a system of internal control. So we bring back internal control, which provides, and now we have another standard here, a reasonable assurance. So we go from accurately reflect to reasonable assurance that the charges are accurate, allowable, and properly allocated, and that the records, whatever they're going to be, are incorporated into the official records, and that they reasonably reflect the total activity for which the employee is compensated, not to exceed 100%. So we've gone from that very, very specific to a very, very general. Now, let me caution you that for the purposes of implementation, this is not in effect yet. However, there's another caveat, which is that it may very well be that this is the place that the federal agency says, we are going to write some standards for what we believe accurately reflects or reasonably assures or reasonably reflects the time, and the federal agency may revert back or may try to revert back to the par and the semi-annual rule. We don't know that. And we also, there's another wild card here. If they try to do that, they may get rejected by the Office of Management and Budget, because let's go through this. The records would encompass all activities, federal and non-federal. That's the general rule already. Comply with established accounting policies and practice, and support distribution among specific activities or cost objectives. Couple of notes here. It does not say, the rule does not say that the agency has to have a time distribution system specifically. It says the internal controls have to be such that there's a reasonable assurance. But that's different than having to say you have to have a written internal control policy, or you have to have a written grants management policy. That's a lot different. So it's gone from that very specific to a vagueness on exactly how you do it, but a standard at the end that says, but it really must be accurate. So that's going to be up in the air for a while till we see what happens with that. There were suggestions in the comments that there be a whole separate certification process here, similar to that certification that I read to you at the beginning of the presentation. And the response in the comment was, that's not necessary. The overall certifications are going to cover that, cover salary payments and things like that. Still, same rule, budget estimates alone cannot be used as support for salary charges, but there's a specific authorization here that percentages can be used. There was an issue that the U.S. Department of Education time distribution people sometimes used to raise, to say that your time allocation for a week, for example, had to, if your week was full-time, was 40 hours, it had to be by hours. So if you were 25% on each of 4 different programs, you had to have 10, 10, 10. You couldn't do 10 hours, et cetera. You couldn't do 25%. But this now specifically says that you can use percentages. There is something that is both old and new. It is old in that substitute systems have been around for a while. But what's new is there's a much greater emphasis here on substitute system. And the substitute system is more like, it's sort of like a cost allocation plan, although that's not what it's called, but it's a system that's used to allocate employee time based on something other than monthly or quarterly or periodic records of how the time is allocated. In other words, it is something that is developed at an early point of time in the year, and then that projects the salary for the rest of the year. And what the substitute system talks about is using a random moment time sampling or an early couple of months that are averaged together and projected, but it also has a general statement of any other reasonable measure. And in offices where the office is transaction-oriented, a reasonable measure can be, assuming that the technology supports this, a transaction analysis. So let's say you have a personnel office, and people in the personnel office do process personnel transactions. So, and the technology can support going through that personnel office and saying, okay, for this month, this individual processed 100 transactions, 50 were Title I and 50 were non-federal. That would support dividing the salary 50-50, and that could proceed in the course of the year. So any time that you have a transaction-oriented office, that particular method works. But the random moments sampling, taking a sort of a time snapshot, another one, and averaging them together, that also works. There's a big support here for that, because part of this whole push was simplicity, reducing the amount of paperwork and records, and clearly, whenever the people from the Office of Management and Budget spoke to all of us, spoke to administrators at the state levels, the local levels, even spoke to people at the federal level, spoke to us where we work in the field, it was almost unanimous that the biggest burden and the biggest pain and the most bureaucratic part is keeping these time distribution records. So this was a move to try to simplify that. It's going to be interesting. We're going to have to wait and see how it plays out, because when you've got those statements from that prior slide, is reasonably reflect and accurate and things like that, that means that an auditor can go in and look at the records and say, we don't think it measures up to this standard. Before, we didn't have that issue. Before, we had, if you had your monthly par and it was signed and it was dated and it was at the end of the period, there was no question about it in the audit. So now there's going to be more of an audit range that is going to be a possibility. If the records meet the standards, if the records meet the standards, but what's the standard? The standard is that they're accurate, but it's not a standard like an objective standard, it's whether they're accurate, then the non-federal entity cannot be required to provide any additional support or documentation for the work performed. So that sort of leaves us with the possibility of the Inspector General, who were all the Inspectors General, who were not at all happy with this, coming down and questioning the accuracy and the reasonableness of the reliance on these records. So this really, it's an attempt to make it simplified, but we're going to have to wait and see how that is going to play out. If the records do not meet the new standards, the Department of Education, this is not from the specifically a quote, but this is us saying that if the agency determines the records don't meet the standards, then the agency may very well require additional support, and we would predict that the agency would go back to the A87 standards. So I want to move to grants financial management systems. There's some new things here, some specific new requirements. So specifically in identification of federal awards as a requirement, I'm going to talk about what that is. Written procedures, both 6 and 7. Written procedures, number 7, are going to really raise some questions, but let's take a look at that. So This is a specific requirement. You may be doing this already, but now it's a specific requirement actually in the circular that the account has to identify all the federal awards received and expended in the federal programs in which they were received. It has to identify them by CFDA number. Those are the references that I mentioned at the beginning. Every federal program has a CFDA number and title and number, also by the federal award identification. This is a accountability kind of thing for the federal funds. Also the name of the federal agency and the name of the pass-through agency. In most instances, certainly the federal agency here will be Department of Education, pass-through will be state, and the grant and the sub-grantee will be a local education agency. The accounting records has to identify source and application of funds in expenditure level detail. This is part of the existing framework. Some of these slides I'm using just to sort of put into the context of where the new requirements come. Has to be supported by source documentation, so it has to go back to the basic source documentation that, because the red indicates that that specific requirement in the circular is new, and also specifically has to include any interest earned on the federal grant. There are some very specific requirements now that are going to apply to interest earned. There are already requirements, but these are some new ones and some new levels of where the requirements kick in and things like that. The internal controls. This is new in the sense of what I mentioned before. It's in the substance of the circular for financial management systems, whereas before it was really just considered as an audit standard. But the non-federal entity has to establish and maintain effective control over the federal award. Now, specifically, evaluating and monitoring the compliance with statutes, regulations, and terms of the federal award, and then prompt action when instances are identified, including non-compliance identified in audit findings. So remember, before we had the prompt action when fraud or abuse or gratuity violation was identified. The prompt action was reporting. This is prompt action even in instances of non-compliance when it's identified in the audit finding. But remember, in this instance, for non-compliance identified in audit findings, these are the areas where we really want to walk it back to take advantage of that COROI flexibility. So if we know before an audit where our weaknesses are, or even if in the course of the audit a weakness comes to light, we want that, the audit finding will come, but we want that audit to include the corrective action, going back again to the definition, the corrective actions that we are, if we can't do them right away, that we're proposing. So if the audit raises an issue, for example, that we don't have a written internal control policy, then we want to make sure that we are immediately putting into place a corrective action plan. So we can't, if the audit's going to be done in a day or a week, we're not going to have our internal control policy in place, but a corrective action is we're going to do a corrective internal control policy. This person and that person are in charge of developing the internal control policy. Here's our timeline. The internal control policy has to go to our board. We're going to get it to the board at the September meeting. As soon as it's approved, then the next step is we're going to do training. So we have that corrective action that is going to go into the audit, and the auditors will put that in because we get a chance, an opportunity to respond to audit findings. So the corrective action, prompt corrective action, will be in the audit, and that will be for consideration to avoid audit recovery. CMIE, the Cash Management Improvement Act, and the CMIA is about cash flow. And it's about the idea, essentially the idea is that money is not to be drawn from the federal treasury significantly in advance of the time that it gets actually expended. And in most instances, we're talking about expenditure at the local level. So we've got drawdown at the state, drawdown from this for the local district, that the district, because the district is the one who will be expending it, and the district is responsible to minimize the time from when it receives funding till it expends it. And if the district has cash and it's in an account, federal cash, there are interest obligations that are created even where the account is not interest bearing. There's imputed interest charge that even if you're not earning any interest, you can end up paying back interest. So there's a requirement here that there are written procedures to implement the CMIA. And that is completely new. Now, here is the what I mentioned about number 7. But on the other hand, what I want to say here is that written procedures for making sure that you don't draw down money a long time before you are going to expend it is a pretty straightforward kind of thing. You can figure out how to do that, what the flow is, where the money comes in. But here on allowable costs, and this is something that we haven't really talked a lot about because allowable costs are, in the circular context, allowable costs are the general kinds of framework that I mentioned, necessary, reasonable, allocable, things like that, and then following all those other kinds of general principles, and within one or more of the cost, the 55 of what's allowable, and some of those are like alcohol not allowable, but they qualify here. But allowable costs, the rule, it refers to following the circular requirements on allowability. But the circular requirement on allowability, and it goes back to one of those first slides, one of the allowable prerequisites is that it's allowable under the program. So compliance with circular allowability swings back to, after it goes through all the circular requirements, it still's got to be allowable under the program. This was always the requirement, but now there's a requirement that there are written procedures for determining the allowability of costs. And when you're talking about written procedure for the allowability of a cost, and you get beyond the circular stuff and you're going to the program, well, first of all, you have to have they're different for every program. What's allowable under Title I is different than what's allowable under IDEA. And then allowability also requires compliance with your school program, with your school plan, school-wide plan if you have one, with state law and rule, which is another aspect of allowability. So there has to be written procedures for determining the allowability of a cost, and that's going to be a fairly significant undertaking, especially in the sense that it's going to encompass all the various programs, federal programs that contribute here. The payments. Cash advances have to be kept in interest-bearing accounts. So if there are cash advances, they have to be placed in an interest-bearing account unless the entity receives less than $120,000 per year in total federal awards. So again, that's not going to affect any of any school district. If the best interest-bearing account would earn less than $500 a year based on all the cash advances, or the depository would require a high minimum balance, or there's foreign government or banking rules that preclude the interest-bearing account. But outside of these, of course, the number one, the 120,000 isn't going to apply. So it's got to be a calculation that the total amount of advances would not total up, would not generate more than an interest of $500 a year. Everything over that has to be paid back to the federal government. There is an allowance to keep up to $500 of interest. So if there is cash received in advance, up to $500 in earning interest, up to $500 of that can be retained for administrative costs. Now, what I mentioned before, which is not in the circular specifically, but has been long-term practice of agencies, is if it's in a non-interest-bearing account, but it should be in an interest-bearing account. In other words, it doesn't fit within these exceptions. It should be or should have been in an interest-bearing account. There is an imputed liability. There is a calculation that the federal government will do to figure out how much interest would have been earned, and that everything above that $500 is considered a liability. And there are very specific audit cases right now that are pending around the country, specifically claiming interest on money that was sitting in accounts but was not literally earning interest. There's a new definition here, the period of performance. It is a new definition. It's not a new concept, but it really just sets out the requirement that allowable costs have to occur within the period of performance. The period of performance, of course, is set by the grant, the approval of the grant, and the beginning period where you can make expenditures. Pre-award expenditures are allowable, but only with the approval of the granting agency. So that rule doesn't change. What is interesting here is a question that I think is raised by the allowable costs incurred. So the charge to the federal award, only allowable costs incurred during the period of performance. The question that this raises is the following. The federal funds are obligated by taking certain actions, and funds for salaries, for example, are obligated when the work is performed. So once someone has worked for 2 weeks, assuming it's a 2-week pay period, those funds are obligated, and that salary check comes at the end of 2 weeks. And that really rarely is going to raise any question of the period of performance. But here's the question that is raised by using costs incurred as opposed to funds obligated. For a contract, the funds are obligated when the contract is signed. So if a contract, let's use a fiscal year that ends on September 30th, if a contract is signed in October, let's say in June, it's within the fiscal year that's going to end on September 30th. Let's say the project period is also going to end on September 30th. But if that contract, let's say that contract is for continuing, let's say, parental involvement activities that are going to go on for a 12-month period. So they're going to go on over the summer, and they're going to continue into the next performance period, the period of performance. They're going to continue. In terms of obligation, the obligation of those federal funds from that prior year are obligated and can be used to pay that contract when it's performed in the subsequent year. So the question is whether the cost is incurred when the contract is signed, or whether the cost is incurred when the services are actually provided in the subsequent year and billed and owed. And so we have a disjunction here, I think, for the time being on those contracts that run from one fiscal year to another, because those are going to run performance period to another. Procurement. We have some significant changes, especially in the world of smaller procurements. And by smaller, I mean some pretty substantial small procurements. Has to have documented procurement procedures. So we're back to written. We have to have written procedures reflecting the requirements, both state and local, and the federal requirements. The requirement is still, this is not changed, to contract only with responsible contractors, and to consider contractor integrity, compliance with public policy. This is for considering contractors' record of past performance, and the resources. That part not new, but here we have a conflict of interest policy. All the entities have to establish a conflict of interest policy, old, not new. We've already had that, and disclose in writing any potential conflict to the federal awarding agency in accordance with the applicable federal awarding agency policy. So here we're going way beyond a conflict that results in a fraud or an abuse or a gratuity violation. We're going way beyond any of those, and just disclosing in any potential conflict to federal awarding agency. So that is very, very broad. And again, for all these disclosures, the rule specifically says that failure to make that disclosure can result in all of the consequences of failing to appropriately manage your grant, which go from sort of increased oversight, increased reporting, getting your money on reimbursement with having you to have more accountability, all the way to termination of the grant. So these are very serious. Now, cost price analysis, a couple of changes that we hear. The actual small procurement policy is now specifically that small procurement policies or procedures can be used under $150,000 procurements. So that raises the bar considerably for small purchase procurements. Now, this rule will operate, even for federal funds, it will operate in conjunction with any state rules. And if the state rules say small purchase procurement is $5,000 or even $50,000, the lower rate is going to apply. But if the state doesn't have a limit, small purchase procedures can be used up to $150,000. Another change and a much greater flexibility here for these small purchase procedures, is this. Under the former rule, which will be the current rule until it becomes former, which will be a year or a year and a half, but it will become former. Under the old rules, every contract, every procurement had to do a cost price analysis. Now, the cost price analysis could be very simple. For example, if we were talking about going out to buy one computer, the cost price analysis could be just going to 2 or 3 stores or going to 2 or 3 websites and looking up the computer, assuming it was a off-the-shelf item, and just putting that in the file. That the Staples sells it for this, Walmart sells it for this, and we bought it online for $10 cheaper than either of those. That was a cost price analysis. That satisfied it, so it was simple, but you still had to do it for every procurement. The rule now says a cost price analysis is not required if you're within this cap of $150,000 for small purchase. So it made the small purchase cap much higher, number one, and also introduced a much greater level of flexibility in making these fairly significant procurements. Now, within small purchase procedures, we have a small purchase procedure called micro purchase, and that's new. And that is under $3,000 or under, with almost no federal oversight. So just sort of really giving a huge level of flexibility. The requirements are micro purchasers are distributed equitably among qualified suppliers to the extent practical, which means that you're going from, if you've got a bunch of stores in your school district and you're buying an article that's available from different ones, that you distribute that equitably. It doesn't mean a whole lot. It just means not really concentrating in one place. But it is a complete exception to the competitive quotation, as long as the entity considers the price to be reasonable. So that there's no cost-price comparison, there's no shopping around, great level of flexibility. Now, non-competitive proposals, the rules on proposals and procurement in terms of sealed bid or competitive bidding or non-competitive bidding have not changed significantly. I do want to always emphasize that even when you fit within the qualification to do a non-competitive proposal or non-competitive procurement, there are always, it's a trigger in terms of the audit oversight or program review oversight, and especially if there are a lot of them. So the non-competitive proposals where the good or service is available only from a single source, the sole source proposal, there's a public emergency, and there's new language here in red. The awarding agency can specifically authorize a non-competitive proposal. This is new. This gives the awarding agency an authority that it didn't have before. And remember, an awarding agency for you as an LEA is the state. It's not, you don't need to get this from the federal government. The district can ask the state in most programs where it's state administered for the permission to do a non-competitive proposal. And finally, if there is solicitation and the competition is deemed inadequate. There is, at the back of this, there are several appendices. We're not going to go through them now, but let's just turn to them so you know where they are. I'll give you a page number where they start. They start on 78672. And they are, the Appendix 1 gives you one of the requirements here that I had mentioned is that funding opportunities have to be publicly made available, and there's a text of what is required in those notices. And then if you go to Appendix 2, which is a couple pages further, 78675, there are contract provisions that must be included. And these contract provisions must be included in every contract that's going to be paid with for federal funds. And they include that you're checking that the entity that you're contracting with is not debarred or suspended, that you have provisions in the contract for termination, both for termination for cause and also termination for non-performance. And there's a whole set of provisions. And then following on, and the appendices go all the way to the end, there are several appendices on indirect cost, on central service allocation plans, when school district gets services centrally from a central authority, or a state gets services from a central authority, how those are to be charged. But those are much more specific than what we're going to do today, but I wanted to make sure that you knew that they were there. Property standards. For federal purposes or federal accountability, there are two or three really classes of property. One is intangible, and that would be like a copyright or a patent or something like that. But for tangible property, and we're not talking about real estate, there are two classifications, and it's really important to be familiar with these two. The rules depend entirely on which classification it falls into. If you start, what you want to do is start with equipment. And the reason you start with equipment is because supplies, at the bottom of the slide, is everything else, essentially. So tangible personal property, it has to meet two qualifications. It has to have a useful life of 1 year, or more than 1 year, and a per unit acquisition cost equal to or exceeding $5,000, unless the state sets a lower limit. State or district or local entity can set a lower limit. But I'm going to deal with the $5,000, even if there is a lower limit, but just for purposes of illustration. If it qualifies as equipment, then it must be inventoried. And the accountability ranges from all of the inventory requirements. And inventory requirements are very specific. What needs to be in the inventory. And they're very specific, and they're all listed. There has to be a serial number. There has to be an identification. There has to be a note of the location, the use, the condition, all of the purchase acquisition costs. And once the item qualifies as equipment and goes on to the inventory, it stays on the inventory as long as it's needed for the program that it was purchased for. And then I'll get into disposition afterwards. But that's the initial sort of entry. And then I'm going to skip down to the bottom of the slide. It's everything other than equipment. Supplies, so it could be books, it could be reading materials, it could be, it certainly would be telephones if you're buying them for administrative staff, iPads, computers, all of those things where the individual acquisition cost is under $5,000. So going to the middle, we've got computing devices falling squarely into computers as long as the individual acquisition cost is under $5,000. That means if you're buying 20 computers and the package cost is $20, as long as each one is under $5,000, they qualify as supplies. However, if you're buying the computers to use as a unit, as a language lab, for example, or a computer lab, and that they're really designed to function together, then the unit cost is the total amount, and then it would qualify as equipment. Now, the reason that this is significant is that before we had the computing devices definition, we just had the basic equipment and supplies, and computers, whether they were desktop or laptop or pads, almost always in the past few years were certainly under $5,000, mostly under $1,000. Historically, of course, sometimes they were much more expensive. But the Inspector General, through a number of audits, said that good internal controls, and good internal controls are required even before we've got this specific requirement. Good internal controls are required, of course, under GAAP, under generally accepted accounting principles. Good internal controls would always account for small and valuable items in sort of an augmented manner, that you just can't look at an iPad the same way as you can a workbook, because one is really very unlikely to be stolen, lost, misplaced, or misused, whereas the other is much more subject to the possibility of theft or loss or misuse or whatever. So the Inspector General was saying that there has to be some type of accountability system for these, and really Inspector General audits were pushing entities through this to say, well, we don't want a subsidiary inventory system. We only want one, so we're going to put all this computer stuff onto our inventory system, even though the purchase price is under $1,000. This came out in the circular just squarely saying that computers or computing devices, as they use the term, are supplies and are to be treated as supplies. So that's not to say we don't know that's not to say we know where this is going to go, because the fact is that there is a lot of money, and especially a lot of federal funds, that are spent on individual types of devices like iPads and those kinds of pad things, and also laptops that do tend to be portable in a way that they're not supposed to be portable, and the internal control review may very well focus on that again. Internal controls, of course, one of the functions, there are many functions, but safeguarding assets certainly is one of the central aspects of internal control. Now here's something that has come that may very well, hopefully should, change some of the U.S. Department of Education policy. The Department of Education's policy has been, if you buy something, let's say you buy a bunch of computers and you pay for them 100% with Title I funds, and you buy them to use them in your Title I function, and they're going to be used in Title I function. That's why you bought them, that's what they're for, that's what they do. But there's an hour every day when Title I just doesn't need them. The Department of Education's position had been that they have to sit, and they can't be used for any other program unless the other program is going to contribute part of the cost. But what the circular now says, that the shared use, as long as the primary use is the program that paid for them, that a shared use, which does not interfere with the use of the program that paid for them and doesn't add to the maintenance costs, and there's a whole bunch of qualifications, but that it doesn't essentially detract from the use by the program that bought them, that this would be allowable. So, but let's look at disposition essentially. It's a path to disposition, but let's say we buy these computers, or we buy a piece of equipment that we pay for a program. So and we don't need it for that program anymore. So the first preference, the secondary first preference, in other words, we buy it for the program, we use it for the program doesn't need it anymore. Now we use it for projects supported by the federal awarding agency, by the same agency, by different projects. Then we use it for projects supported by other federal agencies, and then we can use it for non-federally funded programs as long as those programs were previously federally funded. And then finally, if we don't need it anymore, if the value has gone below the equipment level, so if it's gone below the $5,000 acquisition threshold, if that's what we're using, then it can be disposed of with no further accountability to the federal program. If the grantee is replacing equipment, then the equipment can be replaced. The equipment used can be used as a trade-in without recourse to the federal agency. In other words, the federal agency doesn't have to get credit for that trade-in. Insurance, a couple of rules on insurance that are new. The first one is that the grantee has to provide equivalent insurance. Whatever the grantee uses for insurance policy of its own property, that is the level of insurance that has to be provided for the federal equipment. So that's the first. It's sort of the equivalence rule. But the second new rule, which is a little more harsh, that if the equipment is not insured, and even if we're in compliance, meaning we wouldn't insure this if it was locally paid for, so it's not insured, the loss of that equipment through damage, accident, or theft would not be borne by the federal agency if it's not insured. So you don't have to insure it, but failing to insure it, the federal grant or the federal agency is not going to bear the cost of that loss. Record retention. The changes here are really sort of just really keeping up with what is going on in the real world, which is that electronic records are as good and as reliable and as acceptable as the paper records. And that really a lot of places have moved so far to electronic records that's sort of behind the times. But so it's just a validation that electronic records can be utilized, that you don't have to create paper records, and that if the records are already on paper, they can be transferred to electronic records. There is one thing that I do want to say here. And we didn't put on the slide because it's really a significant concern. The rule says that you must keep records for 3 years after the close of your grant period. And the reason we never put that in here, because we don't want anyone to see that, because you've got to keep records for education department programs for at least 5 years. What's the reason for that? It's not a Department of Education rule that says you have to do 5 years. The Department of Education actually has the rule of 3 years in the regulation. But why do you have to keep it 5 years? Does anyone know? The reason is that in an audit recovery, the Department of Education can reach back 5 years. So if you've destroyed your records after 3 years, the Department of Education 1 year or 2 years later can be looking at the grant period 5 years ago or 4 years ago. You don't have any records for that period. Under a grant audit recovery, failure to support the grant expenditures in and of itself is a basis to recover funds. So even though you've destroyed the records consistently with this 3-year rule, you have absolutely no defense to the audit. You have no way to support the grant expenditures, and you are also just simply in violation of the rule that you have to be able to support grant expenditures. And you have to be able to comply with that rule of supporting grant expenditures for the entire time that you're subject to scrutiny in the audit or the audit appeal or the audit recovery process. So it's 5 years, and it's 5 years from the end of the grant period, unless the state requires longer. So it's a minimum of 5 years. So wherever you see 3 years for record retention, you just need to completely ignore it. Requirements of pass-through entities. In this context, a pass-through entity, of course, is the state education agency. And I want to point out a couple of things here. This circular, while it reduces some of the audit oversight, it actually reduces, I didn't go into this today, but it reduces the scope of what auditors are going to look at in the single audit significantly. The result of that, and it may be an unintended result, but it's a definite result, is the things that are taken out of audit scrutiny and audit review still need to be looked at. So who's going to look at them? Well, it falls to the pass-through entity. So it falls through to the state education agency. And the effect of this circular will be to significantly increase oversight responsibilities for state education agencies. So let's look at the federal pass-through agency specific responsibility. The first new, very specific requirement is that the pass-through entity has to evaluate risk in grants before an applicant receives funding, and has to evaluate the risk based on financial stability of the applicant, the quality of the management system, history of performance, prior audit reports, and the applicant's ability to effectively implement the program. These have to be assessed before the state education agency makes a grant, a competitive type of grant. They don't apply so much in the state administered program, but they do apply for any competitive or specific grant. So the entity has to have in place the framework for evaluating the risk, and then if there is a risk, the agency is required to impose certain conditions. Those conditions can be that the subgrantee is paid only on the basis of reimbursement, that there's a withholding of funds until a certain level of performance has occurred, that the agency, the pass-through, the state requires more reporting, a higher level of monitoring, can actually require an outside entity to assist with the grantee, or in addition, that the entity get additional prior approvals. So all of those things are there, and the pass-through, again, it's an additional responsibility for the pass-through. There is a much greater emphasis on risk assessment on one side and performance on the other in this circular. Pass-throughs must monitor. This is new in the circulars. It's always been a requirement of the programs for the Department of Education state-administered programs. But look at the underlying language. Monitoring now has to include not only the compliance, which we said we're going to try to play down compliance, but has to monitor for performance expectations. That, of course, relates back. You can't monitor for performance expectations unless there are performance expectations. And if there are going to be performance expectations, they have to be part of the grant approval process so that the receiving entity knows what they are and knows what it's going to be evaluated against. And then the pass-through entity, the state has to submit performance reports on how the performance was, how the grant was performed by the sub-entity or the district, at least annually, to the Department of Education. If there's a risk, in addition to those conditions, the following tools can be implemented by the pass-through entity. And this is risk not necessarily that arises in the awarding process, but even through the whole grant administration process. The state determines that the entity is having trouble managing the funds. What kind of trouble could that be? The pass-through entity learns that the recipient, the school district, has a really large carryover balance year to year. That's not supposed to happen. Even outside of your Title I Part A, where there's a limit on carryover funds, on the other grant programs, there's no statutory legal limit. There's no law that says you can only carry over 15%. But failure to expend the funds in the year for which they're appropriated and allocated indicates a weakness, control weakness. So that could be something that triggers the pass-through entity. Other things could be even more obvious, newspaper articles, complaints, things like that. So that in the course of that oversight, the pass-through entity can beef up training, technical assistance, do greater on-site reviews, and even arranging for agreed-upon procedures. In other words, under the agreed-upon procedures, the pass-through entity actually tells the grantee agency, you must contract with an accounting or an auditing firm, and you must have them review your transactions, for example. You must, for the month, you have to review the transactions for a period of time. And you can even, agreed upon procedure can even be, and they have to tell us, meaning they, the outside accounting firm, has to tell us, the state, that you're in compliance for this month before we're going to pay you the money. So there's an oversight process here. The audit requirements, even satisfying the audit requirements, which will be not that different than what you're familiar with, even though they're folded into the circular. The federal entities can require additional auditing, but if they do, it's at their expense. There's some requirements that the auditee has to prepare a summary schedule of prior audit findings and corrective action plan. There always was in the audit process a process where the auditor was supposed to begin the new audit with a recapitulation of last year's audit findings and a review of what was done. But now the auditee itself, meaning the school district, has to prepare this schedule of the prior audit findings and precisely the corrective action plan. This is the cooperative audit resolution that I mentioned before in the definition section. You can see how this really, even before that final paragraph that says using corrective actions to sort of forgive, it doesn't use the term forgive, but to not base the collection of funding on it. But it's prompt corrective action, improving communication, fostering collaboration, promoting trust, and developing understanding. It's all geared to a positive end result, not a winner takes all. When the end result is that the agency disallows the expenditure and says you have to pay it back, it's winner takes all. I mean, you can appeal and win, then the agency has lost, or you can appeal and lose, and then you've lost the money. The agency doesn't really gain anything because that money doesn't go into the agency budget, it goes back to the Treasury. But there's no focus, there's no process by which everyone says, let's put that aside and let's see what happened and how we can make sure it doesn't happen again, and we can see that the program does what it's supposed to do. Audit findings. The audit scope was limited a little bit. The auditor reports on, for the major programs, significant deficiencies, material weaknesses in internal controls. This is not a specifically new requirement, but a much more beefed up requirement, this whole internal control aspect, which brings us, of course, to the accountability. Significant instances of abuse, material noncompliance, and known question costs above $25,000. Inspector General, again, on this one, was really opposed to that, said all question costs should be reported, not just for $25,000. If the auditor finds a question cost for a program that's not audited as a major program, and there's all sorts of qualifications how you determine a major program, it's a sliding scale based on the total amount of funding that is expended by an agency. So the auditor is not necessarily looking at a non-major program, but if the auditor finds a $25,000 finding, that the auditor has to report it. But the fact is that they don't really have to be looking at for it. So that's the end of the presentation. I finished a few minutes early, and I'm going to stick around for any questions, but I know this is really dry at the end of the day, so I want to thank you all for staying around and your attention, and I hope the program was helpful.